Feroz Aziz, Deputy CEO, Anand Rathi Wealth Limited joins us now, and I must say, Feroz भाई, एक ज़माना था हम 3 साल में एक बार मिलते थे, अब 3 दिन में दूसरी बार मिल रहे हैं. सैटरडे भी मिले थे आपसे. आवाज़ नहीं आ रही है फिरोज भाई. You'll have to unmute yourself.
Yes, ये तो मेरी खुशनसीबी है निकुंज साहब कि आपसे मुलाकात होती है तो काफी मार्केट की समझ हमारी बढ़ती है. Heartfelt.
Well, likewise, always look forward to learning more about you, more from you about mutual funds. I mean, one thing I must share with our viewers is that when you look at the data, and that's what Feroz shared with our viewers, that the best performing mutual fund and the worst performing mutual fund in any year actually has a difference of 30%, and that is where his team and his good work comes in terms of doing that data analysis as to how do you really choose the right scheme. So I'm going to take that conversation forward, Feroz bhai, which is, look at SEBI's notification. I will not call it as a directive, but it is more like an alert that small cap fund managers, they need to be careful. They need to have a mechanism in place. How will they deal with risk? How would you read into that notification or that alert from SEBI?
Yes, Nikunj Saab, that was written to AMFI, and AMFI in turn wrote a letter to several asset management companies. Being a distributor, we got a hand on it. I see that as a great caution, point one, but I would not see that in isolation. Like yesterday, NSE released its rejig of all its indices. There you see that they've changed, of course, an initial reaction, I may be wrong, but they've moved from market cap mechanism to free float mechanism. So point one is SEBI is not doing one thing in isolation. They've also written to exchanges, I would guess, because if there is a certain method of indices creation has withstood the test of time, and then suddenly move from total market cap to free float market cap, that's a great move in conjunction with SEBI's letter to asset management companies through AMFI. That's point one. Point two, now they've made 34 changes instead of their limit of 25 changes yesterday night. So there has been a lot of rally because there's liquidity chasing a fewer stocks with lower free float. So I think that's how I would see it. But the letter of AMFI to asset management companies reads the second point seems a little more worrying for me, which says that people should not have a first mover advantage for an exit. I don't know how AMCs would react to that, but I think if an individual investor has bought a scheme with a fair understanding of how easy he can get out, if you restrict that person's exit, which is changing the rule midway in the game, might have a larger collateral damage in terms of sentiment.
But how will it work? I mean, to put it very simple, if you have to redeem a unit, you have to take an application, get it endorsed, and that day's NAV is applicable. Similarly, you can go online and redeem your unit before the cutoff time, and you will get that day's NAV. So, in totality, how will this process be implemented?
Yes, Nikunj bhai, of course, like you rightly said, when business as usual, I could access my money with whatever corresponding exit loads exist. But there have been instances of restricting flows in the past. There are provisions like, if I remember right, in 2008, FMPs used to be liquidatable. But there was a directive where FMPs which were which were bought from a perspective of an exit possibility were locked in as well. We also saw some cases during adverse situations. A fund has the provision to put a stop to redemptions. I don't think it'll get there, but it's each asset management company's reaction to that second point. I think exit load changes could be there with a 6 months window for a person to act, because that's also a provision. If you make any changes to the KIM, you have to give a person 6 months window or 1 month window to exit if he doesn't like the new rule.
As percentage of the total AUM which you are advising, how much is in small cap, how much is in mid cap? And are you consciously looking at advising your clients that, look, the risk reward ratio is not there in small and mid cap stocks?
I think small cap as a word has not changed over the years, but the definitions, English may have not changed, but mathematically they've changed. So to answer your pointed question, we have gone long on small cap from 5-7% as implied exposure in our model portfolio to almost about 27%. We are wanting to book profits anywhere in the next 1-2 months from 1 or 2 schemes of small cap, because that's generated about 55-60% absolute return and about 30% alpha over Nifty for this year. So we may reduce in the month of March 0.1, but not from a huge fear perspective. But I think it's always good practice. If you go right too soon, with God's grace, you should take some money off the table. That could be the sentiment. But having said which, I think small cap index has gone through some changes. The largest weight of small cap index yesterday has moved to mid cap, which is Suzlon Energy. So if you look at the index of 250 stocks and look at its earnings, the earning estimate for the 250 stocks weighted average, according to us, is 670 rupees. The price is about 14,800 odd. So we are looking at an index level only 22p, and Nifty is at 21p. So I think the devil again lies in the detail. There are stocks with 10p in the index. There are stocks with 100, 150p in the index. So I think that the name of the game is going to be far more detailed, and every fund manager has the provision to have 34%, 35% outside the small cap universe, which is defined differently than the index. So there is going to be an evolution. I think that's the process of a market becoming more mature.
Oh, yes, indeed. And do you think that in large part, Feroz, that these restrictions are being imposed given that large mutual fund ownership in low free float stocks can create liquidity issues, and that largely SEBI wants to determine how much illiquidity there is in the market?
Yes, Avan. I think when we did a study in terms of impact of liquidity on different stocks, free float is a very, very strongly correlated variable. If there's lower free float, the same amount of money results in a larger rise. If you look at the delivery as a percentage of market cap and then compare with the free float stocks, that's a very good ratio to see whether free float is something which moves prices up. If the free float is just 10% and money is chasing it, on a given particular day, there are sellers who are not going to come out of the 10% smaller universe, out of the 100% ownership. So free float is a very, very important variable, and we've checked the correlation between free float and the liquidity chasing up or down the prices of a stock. And I think I'm very, very excited and glad that yesterday, of course, a preliminary judgment of mine, they moved from total market cap to free float, which I think is the most sensible way of doing it. And that's how I think the foreigners do it. MSCI index of the small cap has 467 stocks, if I'm not wrong, give or take. That's an arbitrary number, 467. So I was very intrigued to understand their methodology, because all our indices have a round number, 50, 150, 250. But Morgan Stanley had 467. So they go by free float and not by the number of stocks which they want to have in an index.
Final question, looking at a notification or perhaps alert, I'm using the words consciously because it's not a directive. We must make it clear for our viewers. It's not an order. It is an alert and it is a notification which went to AMFI. AMFI wrote it to AMCs and distributors have it. Do you see a conscious change in sentiment that, if you are, let's say, a investor in small cap stocks, if you are a unit holder of small and mid cap funds, when you read this news, when you watch it on ET Now, when somebody will hear this discussion, do you think there could be panic? Do you think there could be a change in mood and orientation towards small and mid cap stocks?
I think not so much. Of course, it dents marginally a few days, but I don't think it can materially change, because SEBI is looking out for the investor. At the end of it, if somebody read the essence of it, they don't want volatility for the investor, and that's what the investor wants himself. So I don't think there's a reason to panic, and I don't think people read too much into it. Because there are other news which come subsequently which distract them from it. But I think it's a great move from SEBI that you have to always, as a regulator, be a little more cautious, because the mutual fund investor is not prepared for underperformance. But having said which, I'm sure SEBI recognizes the fact that there was 4-5 years of underperformance of small cap, and that was the catch-up which some small cap indices were doing. And if you look at a large Nifty stock at 80p, which has a potential to grow at 8, 10, 12%, but another 50p stock in the small cap index, which has a potential of growing at 20, 25%, I would still, in the life of holding that stock for 4 years, at a purchase price, I might have a PE in single digit if that can grow at 25, 30. So there is potential of several businesses. And I really hope this directive improves the research from the institutional research desk. I think we are a very under-researched capital market, we might have the largest number of listed stocks, but institutional brokers don't cover as many stocks as a country like India merits.
Appreciate your time, Feroze. Thank you so much for better explaining the latest rebalancing rules coming out from SEBI and what it means for mutual fund houses.